Welcome back to Incompetent Capital, where accountability for competence on Wall Street is our top priority. Today, we dive into the chaotic saga surrounding Apache, ticker symbol APA, a company that's been riding a roller coaster of analyst predictions. And let me tell you, the results are nothing short of shocking. As we sift through the rubble left by 5 so-called experts who boldly miscalculated their calls, we uncover the real story behind APA and why their misjudgments have cost investors dearly. What led these analysts to issue such reckless predictions? Were they blinded by the allure of quick gains, or did they simply fail to do their homework? With their heads buried in charts and their feet in their mouths, these analysts not only misled countless investors, but also cast a shadow over the integrity of financial advice itself. Their mistakes didn't just hurt their reputations, they shook the very foundation of trust that investors rely on when navigating the murky waters of the stock market. But fear not, dear viewers, as we unravel this twisted tale, we'll also explore the lessons that every investor should heed. We'll delve deep into the actual performance and potential of APA stock, equipping you with the insights you need to navigate this turbulent terrain. By the end of this video, you'll not only understand what went wrong with those misguided analyst calls, but also how to avoid such pitfalls in your own investing journey. So, grab your notebooks, because today's lesson will ensure that you never fall victim to this kind of gross incompetence again. As we gear up to explore the world of APA stock, let's take a moment to address a common frustration that many content creators face: navigating the ever-evolving landscape of YouTube. If you've ever felt lost in the sea of algorithm changes and audience engagement challenges, you know how discouraging it can be. But what if I told you there's a way to turn that frustration into success? Enter Matt Parr's Tube Magic course, your ultimate solution to mastering YouTube with the power of AI. This comprehensive program teaches you how to leverage cutting-edge tools to optimize your content, target your audience effectively, and save precious time in the process. Don't let the competition leave you behind. Click the link in the description to check it out and discover how embracing AI can transform your YouTube journey. Now is the time to seize this opportunity and become the envy of those who don't. The financial blunders we will expose today have sent shockwaves through the market and left investors reeling. These analysts didn't just miss the mark, they completely miscalculated the potential of APA stock, failing to foresee critical developments that could have dramatically shifted their predictions. What could have possibly led them so astray? Stay tuned until the end, and we'll unravel this tangled web of incompetence together. Order in the court. First defendant today is Scott Gruber of Citi, who absolutely blew away the incompetence meter on this one. With his baffling predictions and careless oversight, he set the tone for what promises to be a riveting session of accountability and analysis. Scott began his coverage of Apache back in early 2021. He started off cautious, with an estimate that matched the price of the stock, only to turn around a day later and overbid and scream buy. He held on to this overbid chase and cheer game throughout the entire bull run. Okay, not horrible until the bull run comes near its end, and then unsuspecting investors get screwed over horribly. He kept cheering the stock in the heat of the volatility while completely ignoring the fundamentals. And after the peak, things started to get funny with regards to his emotional stability. Clearly, he saw something as he was erratically lowering and raising his bids tremendously as the stock was clearly on a downtrend. And finally, in the wave of emotional instability, he lowered to neutral. In his bullish calls on APA, Scott completely ignored critical market indicators that signaled potential downturns. He failed to account for the fluctuating oil prices and the geopolitical tensions affecting supply chains, which should have raised red flags about the company's projected growth. Additionally, he cited overly optimistic revenue forecasts based on historical data, without considering recent quarterly earnings that reflected a stark decline in demand. His dismissive attitude toward emerging competition in the energy sector and the company's mounting debt further highlighted a glaring lack of due diligence. By overlooking these fundamental factors, Gruber set a dangerously misguided tone that misled investors and distorted the true potential of APA stock. And his switch to neutral was an indicator of a clear lack of both competence and confidence in his calls. Guilty as charged and sentenced to emotional counseling. Neal Dingman of Truist is another one that is seemingly in need of emotional counseling. Neal began his coverage of APA in 2019 and quickly jumped in to cheer the stock along with a few slightly overshot buy calls. But then As the euphoria set in, he decided to double down and give a strongly overshot buy with a target of 40 in January of 2020. Unfortunately, the stock was about to take one of its many nosedives that it would soon endure in its volatility. As the stock began to dive off the cliff, instead of warning investors, he gave a hold buy call egging them to buy, but not as much as before. Then, in the trenches, he finally declared hold. Then, as the stock began its next ascent, he declared buy, hold, then hold buy, then buy, hold, then outright buy. It's hard to keep track of this guy. He held on to his buy sentiment all the way into the next peak, and to this day. Neal made several missteps in his bullish calls on APA Corporation by ignoring key risks and overemphasizing overly optimistic factors. One of his biggest oversights was underestimating the volatility of natural gas prices, particularly in the markets where APA operates. APA has significant exposure to natural gas production, and Dingman's bullish outlook didn't account for the unpredictable fluctuations in natural gas demand, especially in regions like Egypt and the North Sea, where APA has major operations. Additionally, Dingman overestimated the company's ability to boost production without significantly increasing costs. He cited APA's strong production growth forecasts, but failed to recognize the rising operational and capital expenses that could erode profitability. Another flaw in his analysis was downplaying APA's exposure to geopolitical risks, especially in Egypt and Suriname, where political instability and regulatory hurdles could pose serious risks to operations. By relying on overly optimistic production forecasts and ignoring these significant risks, Dingman painted a bullish picture that didn't align with the realities facing APA, leading to misguided recommendations that misled investors. Now, looking at that chart, you may have some compassion for this guy and think that the jury is still out on this stock, but let us not forget that he has a responsibility to provide accurate information. He ignored clear fundamentals and screamed buy on a stock with ridiculously overpriced targets, guilty as charged and sentenced to emotional counseling and a life sentence of unpaid number crunching at your nearest investment bank. Our next culprit today, Leo Mariani of Roth MKM, began covering this stock back in 2020, and right before it was about to take a nosedive, he overbid by over 30% and calls buy on the stock. Did he do his homework and turn around and call sell? Or at least hold? No, he continued to pound whiskey shots when he should have been showing up to work, crunching numbers, and warning investors, and then showed up to the office hungover a year and a half later and merely lowered his price target to 25 and clocked out again. Soon thereafter, he called buy, which he holds to this day. Leo touted similar specs to Neal in his horribly incompetent bullish calls, and similar to Neal, he was wrong, cheering up APA's strong cash flow generation and exploration success in Suriname, while overlooking the financial strain caused by increasing debt obligations, overly optimistic production growth forecasts, failing to account for the operational risks tied to APA's projects in politically unstable regions. By focusing too much on short-term gains and ignoring the financial and operational risks, Mariani's calls missed the mark, leaving investors with a misguided sense of APA's growth potential. Again, the jury is out on the stock itself, but the way he handled this, especially in the midst of the first nosedive, was grossly incompetent. Guilty as charged. Next, Biju Perincheril of Susquehanna is being charged with number crunching while intoxicated and copying Leo's call flow. As you can see, Biju handled the first crash just as incompetent as Leo did. But Leo at least attempted to clock in more often. After the year-and-a-half whiskey party, Biju continued to drink and make sporadic buy calls into infinity. To his credit, he did call positive/neutral and then neutral/positive before and after the crash, respectively. Nothing for him to brag about per se, but slightly less egregious in comparison to his drinking partner Leo, guilty as charged and sentenced to drug and alcohol treatment. Scott Hanold of RBC clearly needs to go to rehab as well. Scott began his coverage of Apache in 2018 by lowering to an overpriced target of 45. He then clocked out to go party, and he held on to this ridiculous call for over 3 years through a few crashes and beyond. When he woke up hungover and decided to clock back into work, he thought, I'll just overbid by, 55% with a 28 call when the stock was trading at around 18 and call neutral. To this day, his overbid neutral call streak continues, guilty as charged and sentenced to drug and alcohol therapy with our guest therapist, Martha Stewart. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Now that we've exposed the reckless predictions and misjudgments of these so-called experts in Incompetence Court, it's time to shift gears. Let's step back from the courtroom drama and take a closer look at the real story behind APA Corporation. What is it about this company that made it such a battleground for misguided calls? From its fluctuating production numbers to the geopolitical risks and volatile oil prices that play a massive role in its market value, we'll break down the key factors that these analysts failed to properly assess. Grab your pens, because the deep dive starts now. Apache Corporation, now operating under the name APA Corporation, has long been a significant player in the oil and gas industry, known for its large-scale operations across North America and key international locations like Egypt and Suriname. Once heralded for its aggressive exploration and production efforts, APA found itself in the spotlight for both its high potential and its equally high risks. For years, APA thrived on bullish expectations tied to its impressive assets, especially its substantial natural gas reserves and lucrative ventures in the Permian Basin. However, the company's heavy reliance on volatile commodity markets, particularly oil and natural gas, became a double-edged sword. What went wrong? For starters, APA was hit hard by fluctuating oil prices, which proved far more erratic than most analysts had anticipated. As global demand for oil and gas wavered, particularly during the pandemic, APA's revenue streams took a severe hit. Oil prices crashed, but analysts like Gruber and Dingman continued to push optimistic targets based on outdated price forecasts, failing to adjust for the economic fallout. Meanwhile, APA's high exposure to natural gas markets, especially in politically sensitive areas like Egypt and the North Sea, amplified its vulnerabilities. Operations in these regions were plagued by geopolitical instability, making production targets more difficult and expensive to meet. The company also faced rising operational costs, which cut into margins and made its once promising production forecasts far less reliable. Debt levels soared as APA funneled resources into exploration without adequately offsetting the costs, further straining the company's balance sheet. As investors came to grips with the reality that APA's financials were underwhelming, marked by declining profitability, mounting debt, and erratic cash flow, optimistic stock forecasts started to crumble. Production in Suriname, touted as the next big win, became a drag rather than a boost, with operational delays and disappointing results. What had seemed like a safe bet for steady growth turned into a volatile gamble, and as the fundamentals deteriorated, APA's stock began to tank, leaving investors and analysts alike scrambling to reassess the situation. One of the critical lessons from APA Corporation's story is the importance of understanding the geopolitical landscape in which a company operates. Investors often overlook the risks tied to a company's exposure in politically volatile regions like Egypt or regulatory-heavy areas like the North Sea. Ignoring these factors can lead to significant misjudgments about the company's potential growth or stability. When investing in companies with international operations, it's essential to stay informed about political developments, trade relations, and regulatory changes that could affect production, revenues, or costs. Resources such as country risk reports, global news outlets, and government policy updates can provide valuable insights. Additionally, keeping track of a company's risk management strategies and how it addresses exposure to such regions can help investors make more informed decisions. Another vital takeaway from APA's struggles is the strong correlation between a company's performance and the underlying commodity it is tied to, such as oil and natural gas. In APA's case, commodity prices can be incredibly volatile, and companies reliant on these resources are highly sensitive to these fluctuations. For investors, it's crucial to monitor key commodity trends when assessing the potential of energy companies or any business linked to raw materials. Tools like commodity futures markets, industry reports, and economic indicators can help investors track these trends. Additionally, understanding global supply-demand dynamics and how they impact commodity pricing will offer a more comprehensive view of a company's risks and opportunities. By staying alert to these fluctuations, you can anticipate downturns or booms and adjust your portfolio accordingly. Be sure to check out this video for an in-depth analysis of the Buffett indicator, a key macroeconomic metric that has never been more relevant than it is today.